Before I invest in a stock, one of my requirements is that it have the potential to go up by 100% or more within the next couple years. Where you can find opportunities like this and how to invest in them without increasing your portfolio's risk, coming up. It's so good to see you all again. I'm glad you're back as we continue to build your rapidly growing, highly diversified net worth, one video at a time. Now, one of the ways I do that is through individual stock selection. And when I look for stocks to build out my portfolio, I hunt for those with a 100% or greater upside potential. Anytime I tell people that this is one of the criteria before I enter any stock position, I'm faced with similar reactions.
I don't believe it, it's almost too good to be true.
But by the end of this video, you'll know where to find these stocks yourself, why these opportunities exist, why they won't go away anytime soon, and how to use them in your portfolio in a way that won't increase your risk. I find these 100% plus opportunities buried in a pile of overlooked stocks, specifically companies categorized by their size as micro capitalization or microcap. A microcap company has a value between 300 million and 50 million. Now, we also sift through companies considered to be small cap, which includes those with values under 2 billion, and nano cap, those under 50 million. But in our experience, we have found more opportunities displaying significant upside potential and limited downside risk in the world of microcaps. So as I release videos distilling our individual stock ideas for free here on YouTube, and even more of them on my Patreon page, you'll notice that almost all of them fall into these categories: small, micro, or nano cap, with the majority being micro. Well, now you're about to understand why that is. Smaller companies have historically realized greater average returns. Of course, that's not all. They also come with greater risk. Way more microcap companies go bankrupt every year than do large cap companies, if any do at all in a given year. But with that in mind, mathematically, for the average return to be higher, there must also be way more microcap companies increasing in value by 100%, 200%, sometimes even 1,000%, for example. That means a sound, logic-based, research-backed, data-driven approach can unearth some amazing opportunities with asymmetric upside potential. But please don't ever forget the big risks if you mess up. Even with all the research in the world, I wouldn't claim my careful selections will all ultimately play out just as expected. And you shouldn't either. Even if it's your own solid research or the ideas coming from your most trusted friend or the most experienced expert you've ever met with the best track record in the history of the world, there are too many unknowables at play with any given stock to make that claim. So just because you hear a good 500% return microcap thesis from me or anyone else, under no circumstances invest a substantial portion of your money in that lone stock. You just don't, you can't know everything that could possibly happen. You don't know what you don't know.
What don't you know?
I don't know.
I do know, however, that I can tilt the odds in my favor. Remember that video we did on the ideal, the magical diversification? By diversifying across 10 to 16 or so of those meticulously selected companies, we lower our risk of being exposed to those unpredictable non-market risks. Some of the companies in our portfolio will likely increase by multiples as expected. Some will not. And who knows, one or two may even go bankrupt. The goal is simply for those multiple increases to outweigh the laggards. So why does this anomaly exist in the stock market? The big-pocketed smart money on Wall Street does a decent job at assigning a decent job. They do a decent job at assigning a fair value to the large and mid-cap companies. They invest so much in researching those stocks. However, some of the big investment firms, many mutual and pension funds, for example, aren't even allowed to invest in the relatively tiny companies we're talking about, those small caps and smaller. Even if that's not a restriction, like with hedge funds, for example, compared to the billions those larger firms are investing, a non-controlling stake in a $10 million company or a $100 million company, for example, would be a drop in the bucket. Not worth the money spent and time wasted on the requisite research. And research is absolutely required. There are thousands of small and microcap companies to sift through in the United States alone. Compare that to the hundreds of large caps. So it's not that big money investors are unaware of this treasure box of opportunities. It's just not worth their time. The fact that there are less investors, less money making the small cap markets efficient leaves the door open for mispricings. Those mispricings are our opportunities, especially in those situations where you invest in a microcap that grows into a small cap and then becomes a mid cap, and then those investment firms take notice and now, by their own rules, can pile in, driving the price higher still.
That's not such a bad place to be.
Investing in microcap companies is not without risk. Liquidity is limited. Fewer shares of these companies exchange hands over any given period of time. This could work to your advantage as large investors begin to take notice and pile in. It causes the share price to jump rapidly to satisfy their relatively large orders. But it can also be terrifying during periods of indiscriminate selling, when large investors are exiting their positions for one reason or another. This causes the share price to tumble even without any change to fundamentals. That happens. It can make it difficult for you to get out at a fair, let alone reasonable price during a panic. Either way you look at it, the good or the bad, the limited liquidity of microcap stocks makes for a more volatile ride. This is why research is paramount. You have to know why you're invested in the first place. And if the company's fundamentals aren't changing, then are you wrong to be there? Maybe you should hang in there. Maybe you should buy more. Like we talked about in this essential video, you can either do that research by yourself or make sure you have full access to someone you trust. If you've seen the video, you know that open access is essential. If you haven't seen the video yet and you plan on using someone else's investment ideas, whether ours through our exclusive Patreon content or anyone else's, you might want to check it out. Whatever you do, I sincerely wish you all the best and appreciate you spending some time with me here today. Next time, we're talking about 4 ways to make money with stocks. This is just a subset of one of them. It happens to be my favorite, but I want to make sure you're aware of some of the other opportunities out there, and we can explore in more detail whichever ones you like. Just let me know in the comments. If you're interested in that video and others like this, be sure to subscribe and click that notification bell so you don't miss them. That'll get you started on your journey to build your own rapidly growing, highly diversified net worth, one video at a time. If you found this video helpful, let me know with a thumbs up, share it with your friends. Again, thank you. It's been a pleasure. I'll see you again soon. Take care.